Hey everyone, hope you're doing well. This is the Deep Dive. My name's Drew Creekmer. I'm the Director of Advisory Services here at Creekmer Wealth. And I'm joined, as always, by John Creekmer, our founder and Senior Wealth Advisor. And John, it's the start of a new year, kicking things off. And how were your holidays?
Dallas was great. I tried to take a little bit of time off, and that never goes well for me. And I just still love doing what I do and talking to everybody the way I do every single day. To be able to take some time off is kind of like, oh my goodness, I gotta get back in the chair, get back in the groove, and get out and chat with people and give them great information and be able to make good decisions. So glad to be back at it here the first part of the year, and it's going to be an interesting year to say the least. I mean, goodness, Drew, this is 2025, and so we're halfway through the Roaring Twenties. And if everyone will be able to see some information coming out on that, we actually on our LinkedIn page, I think on some of our social media feeds. If you guys are not following the social media, whether it be LinkedIn or Instagram or Facebook or X, which used to be Twitter. I wonder how long people are saying that, but make sure you follow us because we actually had our Roaring Twenties photo come out 2 days ago, and so we're halfway through this decade. But it's also as amazing. We're in the midst of different market cycles. And so it's pretty interesting seeing that. And Drew, we got a number of exciting things happen out last year. We had a bestseller go out on Amazon.com. And so as far as a book, Your Blueprint for Purpose, and if you didn't get a copy of that, make sure you can always download that off of Amazon.com, or you can purchase the book there. Just call the office. Be sure to get you a copy signed by me. Bestseller. Also, I was asked to start giving some input as far as on CNBC and Fox Business and Charles Payne. So you'll probably start seeing that coming out here in February. And then also we were asked to actually be a commentator in a lot of different periodicals online, from the Wall Street Journal to Forbes and Fortune, and even Yahoo Finance, and Charles Schwab has asked us to start giving some input there. So a lot of the work that we do, Drew, you and I, and our financial planning team, our advisory team, our tax analyst, our investment committee is getting a lot of positive reviews on a national scale. And so everyone will see that stuff coming out. So a lot of exciting things. I'm excited back into the seat, getting back to work here this week. And as you can tell, I'm pretty pumped up about where we're at for this year.
Yeah, absolutely. It's going to be an exciting year. And, if you want, guys, if you want to download that book, we will include in the body of this deep dive email a link where you can go to Amazon and actually download that. There's a ton of great learnings and stories in there that John put together. And as John mentioned, as we have videos and articles coming out nationally, we'll make sure to include those as well in the deep dive and continue to share more information, both with each and every one of you, our clients, but also with folks around the country, which is really exciting. And now, John, you talked to the fact that we're in the middle of this decade, and it's been a very eventful decade as it relates to markets and investments already in the last 4 years. But we're going to talk today about some trades that we have upcoming in clients' accounts, doing our annual rebalance. And just big picture, John, what are your thoughts with some of the adjustments that we'll be making here this week for clients' accounts?
I'll tell you what, the last 2 years, we kind of think about the last 3 years. Let's go at the last 5 years. Let's kind of go way back in the day, back when COVID was a thing running around for the first time. So 2020, the market was just kind of crazy. Probably whipsaw with what we saw coming news out with COVID, trying to figure out what that was, and shutdowns, and what does all that mean. And then the market dropped drastically, then it ramped back up. And 2021, we saw a bit of an adjustment on the positive side. Then 22, the Federal Reserve really started raising interest rates, and we saw 11 different increases over 13 months. And don't fight the Fed. And so we saw bond markets actually really going to a negative cycle, down 16% in 22. We saw the stock market down 19% in 2022. 23 and 24, we saw inflation come back down. Back to reasonable levels here in 24. Federal Reserve started taking the foot off of what they've been doing as far as interest rates, and so markets started moving higher in 23 and 24. And so with that, clients had some great returns, no matter what your risk tolerance was over the last couple of years, some phenomenal returns. And with that, really, though we saw, Drew, it really became very isolated. A number of different industry groupings, anything tied to artificial intelligence and technology, really led the way. And so owners of NVIDIA, Broadcom had phenomenal, Super Microcomputer had phenomenal returns, Palantir in there. All of those are sprinkled throughout all of our portfolios as far as on the growth and income side, and even inside our ETF models. And so that was phenomenal. But then all of a sudden, then this last 3 months, we kind of got past the election there in November. We got to December, and the Santa Claus rally did not appear. A lot of people were holding out for that. We know the Dow Jones Industrial Average is sitting about 7% off its all-time high that was earlier in the month of December. The S&P 500 is down about 3.5%, and NASDAQ is also down close to 4.5%. And so we see the market starting to resettle. And at the same time, we see the interest rates in the bond market not doing what a lot of people thought. A lot of people had factored in the Federal Reserve actually decreasing interest rates 3 times in the first half of 2025. That seems to be off the table, quite honestly. And so we're seeing the bond market start to readjust, and it's causing things to move in a different fashion than what a lot of people anticipated. And it sets up to say, what do we do here in 2025? And that actually kind of preempted us to make some trades toward the end of last year to rebalance, take some profits and rebalance. But Drew, it's setting things up here for the first part of this year, the first month of this year, the first week of this year, for us to go through and make some additional adjustments in portfolios.
Yeah, absolutely. And just high level, guys, some of those adjustments, we've taken gains off the table in Q3 and Q4 of 24 on the stock side of things. So your gains have been nicely protected during this recent drawdown. And the trades we're making on the stock side, again, likely just to take some gains off of those high flyers that you all have greatly benefited from in 23 and 24, and be a little bit more conservative as we move here into the start of 2025. Like John said, we're starting to see some things settle and some pullbacks occur in equity markets. And John, on the bond side, you talked about this loosely, but the bond side, guys, for some perspective, is much larger in terms of dollars than the U.S. stock market. And so it's really critical to always look at what is the bond market doing, because that speaks to, in a broad sense, the health of the overall economy. And historically, people would say, hey, you own a bond so that when stocks sell off, you retain your principal that's invested in bonds. But John, one of the studies we just did went all the way back to the mid 70s, so over the last 50 years. And we took a look to see, how do stocks and bonds trade? Are they moving in the same direction? So if stocks are down, bonds are down, or if stocks are down, bonds are up. And what we're seeing today is that stocks and bonds are very tightly correlated and at the highest level in the last 50 years. And so, John, when you hear that stocks and bonds are trading in the same manner, what are your thoughts as it relates to our clients and helping ensure that dollars are invested in the best way possible?
I think you really have to consider, what does that mean? Typically, whenever you see, it's kind of a yin and yang, right? So whenever you see stock market volatility, you find safety in bonds, particularly U.S. Treasuries. Whenever you see U.S. Treasuries get more volatile, you see a little bit better opportunities inside the stock market. And so it really depends upon what you're looking at. And so those are historical norms of things that we see. But right now, things are moving in unusual fashion. So keep in mind, folks, back in 2020, whenever COVID hit, we had the federal government, and not just in the U.S., but all around the world, they made some decisions that they had to walk through. And there's always truth in time on were those decisions good decisions or bad decisions. But ultimately, they flooded the market with so much capital. We had the largest level of dollars in the system in the history of our country. And there's so many dollars in the system that the system wasn't used to that. So then all of a sudden, they started pulling dollars out of the system at the tune of $20 billion a month, $10 to $20 billion a month. And then we drastically increased interest rates and decreased interest rates. That caused everything to move in an unusual fashion because man had got involved and started artificially inflating the markets and adjusting the markets. So now all of a sudden, then whenever they're starting to remove themselves to a certain degree from that, it's causing the markets to move in unusual fashions. Typically, whenever A happens, then B happens. Then B happens, we can expect C to happen. Right now, we're not seeing that. And that's all because of the man-made influence we've seen in the markets. And so right now, whenever we're seeing the bond market and stock market moving in tandem, that means that there's very little correlation between them. In other words, it's highly correlated as far as with risk in the market. Well, that causes us to take a step back and say, we need to adjust what we're doing inside portfolios to make sure we're managing risk appropriately. And so right now we see the 10-year Treasury sitting about 4.54% on the 10-year Treasury. It was actually about 4.2% 2 months ago. Well, that's kind of interesting. It's interesting. Inflation has supposedly come down to more of a normative range. You would think interest rates should come down, anticipating future decreases, but we're not seeing that. And what that's telling us is tremendous uncertainty in the overall marketplace, which is causing bonds to move in a counteraction to what we normally see. So that means in the portfolios, we need to adjust it accordingly to make sure the proper risk in the portfolios.
Yeah, absolutely. And John, you spoke to back in 2020, just seeing man stepping in, the government stepping in, and doing a lot of things artificially. And so, if we go back, folks, to 2020, that's when we started utilizing buffers instead of fixed
Mm.
income and portfolios. And John, today I was just doing a year in review. Since 2020, our buffer model's up 34%
Mm.
versus the U.S. aggregate bond index is down 7% over that 4-year time period. And guys, the U.S. aggregate bond index is all the publicly traded bonds in the United States. So there's a 41% gain that you all experience by moving funds out of fixed income over into buffers. And so buffers are a tool that we'd recommend that if you need a refresher on, talk to your advisor. John, we've also seen some great fixed products. Rates right now are still very competitive on fixed products, which protect your principal against potential market loss, but allow you to participate in some of the upside. And so there are other tools out there outside of bonds that we would recommend you have a conversation with your advisor about. Our team is fully prepped on all the current marketplace and options and tools available to you all. We strongly encourage you to have that conversation, and we'll continue to make adjustments behind the scenes on your behalf as we navigate the months ahead. Now, John, we've covered some ground here and talked a little bit about the year ahead, and we'll continue to send out communication to everyone as we walk through the year. But what's just one big picture item that you want everyone to focus on as we move into a new year ahead of us?
I'll tell you the big is there's really two, Drew, but they're actually working together in concert. So the first one is you always want to make sure you invest according to your goal objectives. So what's a goal objective? A goal objective really is, financially speaking, you need to have a time frame of when you have the money invested, and then you have a dollar amount tied to that time frame of how many dollars you're going to need to remove from the portfolio in that period of time. Well, it allows you to set up what your risk tolerance is, which then gives great direction for what investment tools to use. Now, that being considered, I want to encourage you to think through this. Anytime there's volatility, we all of a sudden then start to see people start to react based upon that volatility, because volatility creates uncertainty. And if we have uncertainty, no matter what our time period is, it's like, oh my goodness, I don't want to go back into 08 and 09 and 10 when the markets dropped down, or in 2020 when the markets crashed down, or even 2022. Uncertainty was created. What you need to remember is that you can make money in any given market cycle. So if you're sitting with a large amount of dollars sitting inside a savings account or inside a money market account, we've seen rates in savings accounts and money market accounts actually drop down, even though the yield in the 10-year treasury has increased from September of 3.6% up to 4.57% today. So we're seeing opportunities in the market by being able to react to what we're seeing in the market. So in other words, uncertainty is increasing. We're heading into a new year. We have a new environment. We actually had even one terrorist attack on U.S. soil with a U.S.-born citizen executing that attack. What does that mean? That creates uncertainty. You can make money in uncertain times by making sure you're investing appropriately with the proper set of tools with active management being applied. So folks, even if you're sitting there, talk to your advisors, make sure you talk with them and express what your goal objectives are, time frame, and when you need the money, and then make sure you're not letting your lazy money sit there and be lazy and not be actively invested for you.
Yeah, absolutely. John, I love those thoughts. Guys, if you have any questions, reach out to our team. Our advisors are standing by and fully briefed on everything going on in the current marketplace and are here to help you achieve your goals. There's a link to John's book here in the body of this email, so feel free to take a look at that and download that. It's well worth the time to sit down and read that. So, guys, appreciate the time. Excited to see what the new year has ahead for each and every one of us, and we'll talk to you all soon.